Give it just another couple of seconds. I apologize for, starting a minute or two late there. We're having some technical difficulties with my laptop, but we are in. So I'll give another couple of seconds. I can see people kind of flooding into the webinar. So as an introduction, I'm DJ. I work with Ben and Navigate Financial. And I'll be hosting the webinar this morning on taxes and investments and how that all works. So some of you may have been expecting to see Ben's face as you popped in. So hopefully you were not too shocked, and we can have a good conversation here today about investments. With that being said, okay, let's get started, and we have a limited amount of time here, so we'll get going. As a disclaimer or a disclosure, whatever you want to call it, today we're going to be talking about tax forms and topics related to investment accounts. We're not going to talk about other tax-related information that are outside of investment accounts. There are so many other forms and different things that you'd have to, that you put together for your taxes. And we don't offer full tax, we don't offer tax advice. It's educational, and we want to just make sure everybody understands that. And we encourage clients and anybody to, seek out a tax advisor if you have specific questions. But hopefully this presentation here today will give you a little bit of clarity on how some of these forms work for investments and how taxes work with investment accounts and things like that. That's our goal, and that's what we're hoping for. And also hoping, hopefully it doesn't get too boring. We'll try to keep it quick and move through. As we get into the conversation of taxes and investment accounts and how they relate, I just wanted to bring this up for those of you that were on our webinar back in, I believe it was November. Ben, he likes to often talk about the three buckets of different types of accounts. So on the left over here, you have your taxable account. Those would be, individual, could be a joint, a trust, things like that, taxable accounts. And then in the middle, you have your tax deferred or pre-tax, your traditional IRAs, your traditional 401ks, things like that. And then on the right, you have your tax deferred retirement account. That is a after tax. So you got the pre-tax and after tax, or the after tax is also known as Roth. So Roth IRA, Roth 401k, things like that. So when it comes to these three different buckets, obviously you have different forms or tax forms related to them, because from a tax standpoint, they are treated differently. So I'm going to real quick here this up. So for the taxable accounts, it's pretty simple. You'll see that for taxable accounts, you have the 1099, and for tax deferred, whether they're pre-tax or after tax, you have a 1099-R. Yeah. Okay. So on the 1099, what we're going to go through today, we're going to walk through and do, a demo walkthrough of some sample 1099, so you can take a look at it. And if you have a 1099 from a taxable account, this should be familiar. Now, ours is from an account at Schwab, who we custody at. So that it will be in their format, but for the most part, whether it's a bank, a savings account, or different things, it will look similar or have at least the same information. Now, the 1099 is broken up into a few different parts. You have the 1099 DIV for dividend, you have the 1099 INT for interest, and then you have a 1099B. Now, those are all compiled together. The 1099B would be for sales of investments for gains or losses. 1099-R for retirement accounts. So for the tax deferred accounts, it's a lot simpler. Well, that'll be really quick and easy to go through. Just because it's tax deferred, you're not worrying about taxes as things grow, or when you sell them. All they care is money going in, money coming out. So you'll see that reflected on the two different forms, the simplicity of the 1099-R and how complex a 1099 can be. Now it can be, depending on the investments you hold and how often you sell or how much money you take. It's a little different there. Each account's going to look different. We tried, to pull in a sample account that would showcase some of the, more common themes of a 1099. We'll keep going. So like I said, we'll go through the first part here. We're going to be going through the 1099. So go through here. So if you receive a 1099, this is the main page. Now I have blocked out any identifying information, but this is what it would look like. You have, if you work with an advisor, you'll see it'll show who that is. It's just kind of that main initial page, nothing too special here. But first on the form, you'll see what is the 1099 DIV for dividend. This portion here is for dividends and distributions during the year, and it lines it out. So we're going to go through a couple of the different things here, just so you have an idea. Some of you may do your taxes on your own and have to use this, but a lot of you may be going with a tax professional. But it never hurts to understand the accounts, how they're treated, especially as you're investing or deciding where to take money from, right? So like I said, 1099 DIV or the DIV reports dividends and distributions received from investments that are in taxable accounts. So as we go through here, you'll see there's a list of different boxes on here. We'll go through each of those. So box 1A at the top, it says total ordinary dividends. This is just the sum of all the dividends received before any distinctions of how they're supposed to be taxed. So, if you, in this case, we have, this individual during the year of 2024, they received about, what is that, $15,380 worth of, or yeah, 390. So 15,300 and change of dividends during the year. So that in total, that's what they received on all the investments. Now, box 1B, just below that, you'll see qualified dividends. Now, in this case, they have 7,300. So a little over 7,000 of those 15,000 dividends are considered qualified dividends. What that means is that they are eligible to be taxed at a lower capital gains tax rate. It could be 0%, 15%, 20%, but at a lower rate than the rest of the dividends. And the criteria for that is if you hold the stock or investment for more than 60 days around an ex-dividend date. So we won't get into that too much, but you can see here that nearly half of the total dividends were considered qualified. So that'll be good for that person, that they have a lower capital gains tax rate on a portion of that money. So keep going down. You have box 2A here for total capital gains distributions. This just reports all the capital gains distributions from mutual funds or ETFs, ones that are taxed at long-term capital gains rates. Now, in this case, you'll see that 11,000 of the 15,000 for this individual was at that long-term, from a mutual fund or ETF. So a good portion of that there. And really the only other, you'll see here, the rest are zeros. They're very specific situations, depending on the type of gain or if they fall under a certain tax code or section. So if you have certain investments, you may run into some of them. Most people probably won't. I will bring attention to the $60 amount that is in the middle on the section 199A dividends. So what this means, and this is more common, is that you have there, it reports dividends that are eligible for the 20% qualified business income or QBI deduction. So basically, a lot of times a very common example of this could be if you're invested in a REIT, real estate investment trust. that some of that income or those dividends from that investment could be considered qualified business income. A little advantage there, so you get a deduction. So, anyways, just depends on the investments. In this case, they had a small amount that was considered qualified business income. So that's the 1099 div portion of it. This is the purpose is just this or differentiating between qualified and non-qualified dividends on this. When you're doing your taxes and figuring out where certain qualifications or deductions are met. So that's the 1099 div. Let's keep going here. So the next portion, we're going to be moving into what is called let's go here to the 1099 INT, or for interest. So purpose of this portion of the 1099 is to report interest income earned. It could be from bank accounts. So this will be a very common one that you see with bank accounts or CDs or bonds, things that have interest-bearing investments. Now, just so you know, if you will not receive a 1099 INT on an account that is under $10 per year in interest. So you may have I don't know, from when you were younger, or a child that has an interest account that maybe isn't getting a lot of interest, or maybe in a checking account that has a very low interest rate, and you don't get over that $10 a year in there. You're not going to get one of these 1099s. So that's the threshold. It's a pretty low threshold. If you have money in a savings account, you're probably getting over $10 a year in interest. So if you don't receive it, that would be why. But these can be issued by this form of the 1099 is issued by banks, credit unions, any financial institution that you have an account. So Schwab in our case, so investment accounts that have interest bearing. It could be a bond, it could be a CD, things like that. CDs and bonds are more common. Could be or also a money market fund, as Ben had talked about in the previous webinar, talking about the difference between all these different accounts. All of those accounts are going to put out the 1099 INT. So quickly going through some of the highlights of the key sections on this form. We don't want to dive too much into the weeds because, again, this is a very simple, most people's 1099 is going to look like this. And as you can see, there are 17 boxes there, from bond premiums to, if you're withholding taxes or, investment expenses, foreign taxes, stuff like that. Most people are probably not going to have, unless you're investing in very specific or highly specialized funds, that you'll have stuff like that happen, but or investments, private equity, things like that. But for most people, it's going to be pretty simple, especially if it's in a savings account at the bank. You just got your interest income. That's number one, the box number one at the top. Now, in this case, for this individual, that's where all of their interest income came from. It's just plain normal things. Now, tax treatment on this, just so everybody's aware, it is taxed as ordinary income. And when we're going through dividends, you have long-term capital, you have capital gains, income. This is just ordinary income. That's how it is treated as taxes. So it's pretty simple there. You just, add that to your income there. Box number 3, if any of that interest is from U.S. savings bonds or treasury obligations, what that means is that it would be federally taxable, but it's state tax exempt. So if you had a number there, it's how it's treated. If you're going to pay federal and or states. Now, in that case, if there's anything there, that portion of money would be state tax exempt. Box number 8. If we go down to tax exempt interest, it would be any interest on municipal bonds that are exempt from federal tax and possibly state tax, depending on where you live, right? If you have a municipal bond in the state that you live, that would also be exempt there. Obviously, in this case, it's 0. But if you had a municipal bond in your portfolio, then you may see that. see a number there depending on the interest that was received from that. And then, like I said, you have a lot of other things. Foreign taxes paid if you're investing in something outside of the U.S., specifically an individual stock or an ADR or something along those lines. You may be receiving interest that is reportable, but you have to worry about the foreign country taxes and things like that. For most people, pretty simple, probably going to be a zero there. So just something to note here. This is where our, as an advisor, we come in. One of the strategies here is leaning on those, as you probably could tell as I was talking through, municipal bonds can be, get you that tax-free interest in federally, but depending on where you live and what municipal bond you invest in, it could be state tax exempt as well. So that's that's something that we would consider. If you're in a higher tax bracket, feel free to reach out to us. We can look into that as an option for you to receive, interest income in a way that would be tax free. So in a taxable account, not as much of a benefit for that if you have an IRA, because you're already in a tax deferred environment, so that it grows tax deferred there. So in this, we're talking taxable accounts here. The next one, and this is the last portion of the 1099-B, so we'll kind of 1099 is the 1099-B. Now, this is used by brokers or investment firms, so you're not going to receive one of these from a savings account at the bank. The reason being is it is to report gains and losses from the sales of stocks, bonds, mutual funds, any other security that you have in your account. So it'll detail when you bought it, when you sold it, how much did you get a gain or loss? Is it long-term, short-term? That's really the purpose of it for taxable accounts. So if we go through like we did before, box 1A there, you'll see it's the description of the property. You're going to have the number of shares that of what investment. On this case, let's look through here. So they break it up into short-term and long-term transactions. So we're looking at the short-term transactions for this individual. So they held the first one there, 272 shares of that Macquarie Diversified Income Fund, and it had the DPFFX is the ticker symbol. And you'll see on 1B, if we go over the date acquired, you'll see on the top, it is when it was purchased, and then the date on the bottom when it was sold. And so in this case, is considered a short-term transaction. It was bought and sold within the year. And you'll see there that the first, on that in what is that? September of 2024, this individual had sold $10,000 worth of the DPFFX, or the Macquarie Diversified Income Fund. Their cost basis when they purchased it, it was worth about $9,740, sold 10,000 of it. And so, there's a $259 gain, right? Realized gain. So as we go through there, then on the right, no federal income taxes were withheld. It's pretty common on a taxable that we're not going to withhold taxes there. We could on some of those, but for the most part, you're going to see zero there, at least for clients of ours. So as we go down, you'll see there that's those are the different gains there, the short-term gains for different sales throughout the year. Now, this form may be shorter or longer depending on how much investment activity is done throughout the course of the year. Now, in this case, it's not too heavy. I think there's one more on the next slide. If I go over here. So continuing on the short term. Now, in this case, they listed out on that second, we have a Macquarie National High Yield Municipal Bond Fund, and it was sold in, when is that? August there, for 31,000, and it was worth a little bit more. So there's a little bit of a loss there. And then at the bottom, you have your totaling out, right? They'll go, okay, total proceeds, total cost basis, and then you have your total realized gains or losses. In this case, for the year, this individual had $400 worth of gains, short-term gains that were realized. So they take from the previous slide, add those together, minus the 101 from that one loss there, coming out to 447. Pretty simple, but this is how they think about the investments. They want to keep track of when you purchase it, what price was it purchased at, because when you sell it, they need to know whether you made or lost on that investment, so that they know, exactly, what, what to tax it at. Now, I will make a note that, the difference between short-term and long-term uh, transactions here. If you hold it for more than a year, you would be taxed at. There's a long-term capital gains rate, short-term. So it's really what they're doing. They're trying to figure out what money is to be taxed at certain rates. So um, I wanted to also show this as well. We don't have to go through this in as much detail, but they also will have, you'll see these are long-term transactions, same format, and they'll go through and they mark down, gains or losses on long-term, meaning if it's held for more than 12 months. So you see some of these that were bought in 2020, sold in 2024, and the amounts there. So one little piece here with the 1099-B. One thing that they look out for is wash sales. It's a common thing that comes up as people are doing taxes. And what that means is that you cannot claim any losses against your gains if you bought or sold the identical security within 30 days, right? So say you sell it March 1st, and then you buy it again March 27th or something, and you get a loss there, and you claim a loss and then you buy in again. That'd be considered a wash sale, and for tax purposes, those losses would not be considered or be able to be claimed on your taxes there. So just a little thing there, probably not very common for individuals. We will stay away from wash sales. We have restrictions on as a firm of what we can do there, but for anybody doing their own things, just know that is the case as from a tax standpoint. And this is just continued on the long-term tax rates there. So real quick, I'm going to take a quick pause and see if there are any questions. I don't see anything here. Must mean I'm explaining things pretty well. So we'll keep going through with the 1099-R. This will be really quick. It's just one quick page. And then we've got a couple of, kind of putting it together, and we'll see if there are any other additional questions. So feel free to start shooting in questions in the Q&A if you have them, and we'll answer those with the last couple of minutes. So the 1099-R, you receive those. It's very simple. And typically, I kind of zoomed in on one. You'll see it repeated 3 times over for the different copies there, but they all have the same pieces of information. Now, again, blocked out. This is a sample. Blocked out information that would be identifying to this individual, but this person has a traditional IRA, and during the year of 2024, they took out $85,000 for the year, withheld $9,900 from federal and $4,500 from state. So it's very simple. It's very similar to what you probably are used to or have seen with with a job, that each year you get this form. It's a very similar format, and really all the purpose of it is to report the distributions from traditional IRAs or IRAs in general. Could be 401ks as well, pensions, annuities. If you take out more than $10 per year. Now, in this case, this is for an IRA, but it will look very much the same if it is for a retirement plan, if you're pulling money out of a 401k or a pension or an annuity or something like that. Key sections to highlight, it's pretty simple. Box number 1 at the top, the gross distribution, that's how much was taken. And then how much is, and then you'll see below it 2A, what's the taxable amount? Which portion of it is taxable? And so it'll look different if you're pulling money from different sources here. Now, again, in this case, you can tell it's a traditional IRA because the full amount is taxable. So that would be, that's that there. Keep going down. Box 2B. I'm gonna make note to this here. Sometimes, especially with 401k, that you see it's marked as taxable amount not determined. So these companies, Schwab in this case, or other institutions, they're not determining what amount is taxable. If they know, they'll put it, like in this case. But if it's unknown, they'll usually check that box and leave it up to the tax professional to determine the true amount that is taxable. They're not claiming that they know exactly what it is. So you'll see that box checked, and it may leave it a little funky if it's a Roth IRA or pulling from a Roth, like 401k, something like that. Let's see. And then, going down, number 4, federal income tax withheld, pretty simple. Number 7, they'll do a distribution code. Now 7 is a normal distribution, meaning you're over 59.5, but you may see it different there if you pull in early. Number 1 is the code for early withdrawal. 7 is for distribution. And you may get a 1099 if you do a rollover. So if you're moving from a 401k to an IRA, even though it's staying in a taxable account, the distribution code would say a G, which would be direct rollover. So it's not a taxable event, but they still need to say, hey, they took money out of this account. We don't know exactly where it went. Taxable amount not determined. And they said they rolled it over, but don't know that. That's what the institution is saying there. So if you do a rollover from a 401k to an IRA or a 401k to another 401k, expect to receive a 1099-R for that 401k, even if you're under the age or you didn't take any distribution, you just did a rollover. So heads up there for people that are in that situation. Number 14, state tax withheld, pretty easy there. So last thing here, and I'll spend a brief moment, but possible questions to consider, things that pop up. Should I sell certain investments rather than others? So in the world of taxable accounts, this would be for a taxable rather than a tax deferred. If you sell investments at a loss to offset gains, so for example, say you had a stock that had a $3,000 loss and you had another one that had a $3,000 gain, you sell them both there, it would reduce the taxable income. They'd offset each other. Just to note that the max per year is $3,000. So say you sell an investment that has a $10,000 loss. Well, year 1, you could take a $3,000 and you can spread that over, in this case, 4 years, $3,000, $3,000, $3,000, and then $1,000 the final year. So max of $3,000 that you can sell off as a loss to offset gains. Now you can sell off more, but you can pass those losses on for years, roll them over. So there's that. Another one, should I move money from one bucket to another? It's something to consider, and please reach out to us if you have questions. Moving from traditional to Roth, I know Ben talked about that back in November, but with all of these things, you'll see the 1099-R, even moving money from a taxable and trying to find a way to get that into a tax deferred in some way, shape, or form, whether it be 401k or IRA, could be beneficial. It simplifies taxes. You'll see those two forms are so different. And one is much more complex and the other is simple. It's you took money out. Did you withhold taxes? Great. So that would be a Roth conversion. Please talk to us if you want to have that conversation, either a Roth conversion or contributing more into your 401k, or how to get taxable money into a tax deferred environment, how to do that efficiently, stuff like that. Please let us know. We'll skip over. How should I manage my investments in order to maximize tax efficiency? Like I said, municipal bonds, different, either being in a tax deferred account, different stocks, or how you're receiving income. There's a lot of ways to do that. Please, if you have questions on that, reach out to us. And then the withdrawal strategy, we always suggest taxable accounts first, and then depending on the individual and how, but typically the rule of thumb is taxable accounts first, then tax deferred or a traditional, and then finally Roth for tax efficiency. That's kind of the order of operations with those different ones there. So with that, I know time is kind of up. I think we answered most of the questions that came in. So there we go. I think everything that's, if there aren't any of the questions that we do have on here, let me look through them. Looks like they were related to some of the other things that we talked about. So with that, we are out of time, and thank you so much for joining this webinar today. Sorry for feeling a little rushed here at the end. Sometimes the taxes can they take a little while to go through those. Hopefully, you found it informative, of how these investments and your portfolios and your accounts show up on taxes, and how what forms look like, where to find things on there. As always, if you have any questions or you run into anything, feel free to give us a call. Here's our phone number. You can shoot us an email. Go to our website, book time, whatever that looks like. Phone call is usually the easiest. Reach out to us. We love to answer questions. We want to help out. And we're happy to do so, especially as it pertains to the investments. But like we've mentioned over previous times, we want to provide holistic financial advice. So not just taking a look at the investments, but looking at all the different areas of your financial life, and whether it be budgeting, debt, estate planning, retirement planning, whatever that looks like, insurance and taxes in this case. We have limitations on what we can do in certain areas, but we're happy to help as much as we can and help to guide that conversation and help you through those questions. So please give us a call to 801-905-1644. Again, thank you so much. Sorry for going a couple minutes over here, but hope you enjoyed it and have a good rest of your Thursday. Thank you.